Hey everyone, welcome back. Today we are going to talk about something that's absolutely fundamental if you're trading in the stock market. Whether it's Nifty, Bank Nifty or individual stocks, we are talking about technical analysis. So what exactly is technical analysis? Simply put, it's the study of price movements and patterns on charts to predict where the stock or index might go next. Unlike fundamental analysis, where you are looking at company balance sheets and profit reports, technical analysis is all about the charts, the price action, and the patterns that repeat themselves over time. The core belief behind technical analysis is that everything is already reflected in the price. All the news, all the earning reports, all the market sentiment, everything is already baked into the current price of Nifty or any stock you are looking at. So instead of trying to figure out if a company is undervalued, you are just looking at what the price is telling you. Technical analysis is built on three main assumptions. First, the market discounts everything. Second, price moves in trends, either up, down or sideways. And third, history tends to repeat itself. The patterns we see today in Nifty charts are similar to patterns we saw years ago because human psychology doesn't change. Let's talk about charts first because that's where everything begins. When you open your trading terminal and look at Nifty or any stock, you are looking at a chart. The most common type is the candlestick chart. Each candle shows you four things: the opening price, the closing price, the highest price, and the lowest price for that time period. Green candles usually mean the price closed higher than it opened. Red candles mean it closed lower. Just by looking at these candles, you can start to read the story of what's happening in the market. A long green candle on Nifty tells you buyers were in control. A long red candle tells you sellers dominated. Now let's talk about trends because this is where the money is made. An uptrend is where you see higher highs and lower lows. If each peak is higher than the previous peak, that's an uptrend. You want to be buying in an uptrend. A downtrend is the opposite: lower highs and lower lows. In a downtrend, you either stay out of it. If you know what you are doing, you can short sell. Then there is the sideways trend where Nifty or stock is just moving between a range. It's bouncing between a support level at the bottom and a resistance level at the top. Support and resistance are probably the most important concepts in technical analysis. Support is a price level where buying interest is strong enough to prevent the price from falling further. Think of it like a floor. If Nifty keeps bouncing off 21,500 multiple times, that becomes a strong support level. Resistance is the opposite. It's a ceiling where selling pressure prevents the price from going higher. What's interesting is that once support is broken, it often becomes resistance, and once resistance is broken, it often becomes support. Now let's talk about indicators because this is where technical analysis gets really powerful. Indicators are mathematical calculations based on price and volume that help you understand momentum and trend strength. Moving averages are one of the most popular indicators. They smooth out the price data, creating an average of prices over a specific period. When the price is above the moving average, it's generally bullish. When it's below, it's bearish. RSI or Relative Strength Index measures whether a stock or index is overbought or oversold. Generally, if RSI is about 70, the stock might be overbought. If it's below 30, it might be oversold and due for a bounce. MACD is a trend following momentum indicator that traders love using on Bank Nifty or intraday trading. When the MACD line crosses above the signal line, it's a bullish sign. When it crosses below, it's bearish. Volume is something that many beginners ignore, but it's absolutely crucial. Volume tells you how many shares or contracts were traded. High volume confirms the strength of a move. If Nifty breaks out of a resistance level with high volume, that's much stronger signal than if it breaks out with the low volume. Let's talk about chart patterns because these are what traders look for every single day. Patterns are formations that appear on charts that have a tendency to lead to predictable moves. The head and shoulder pattern is one of the most reliable reversal patterns. You'll see three peaks where the middle one is the highest, and when the price breaks below the neckline, it's a strong sell signal. Double top and double bottom patterns are also very common. A double top appears after an uptrend when the price makes two peaks at roughly the same level and then falls. A double bottom is the opposite. These are reversal patterns that you will see all the time on individual stocks. Triangles are continuation patterns. They show consolidation before the price continues in its original direction. You will see these on Bank Nifty charts quite often during trending days. Candlestick patterns deserve special attention. A doji shows indecision in the market. A hammer at support is a bullish signal. A shooting star at resistance is a bearish warning. These patterns reflect market psychology in a visual way. Now let's talk about time frames, because this is important. The same stock can look completely different on different time frames. Nifty might be a strong uptrend on the daily chart, but in a downtrend on the 5-minute chart. For long-term investors, daily and weekly charts matter most. For swing traders, daily and 4-hour charts are key. For intraday traders, you are looking at hourly, 15-minute and 5-minute charts for Bank Nifty or stocks. The important thing is to start with the higher time frame to understand the bigger trend, then zoom into lower time frames for precise entry and exit points. When you are doing technical analysis, it's important to combine multiple tools. Don't just rely on one indicator or one pattern. If you see Nifty breaking out of resistance level, check if volume is increasing. Check if RSI looks good. Check if the MACD is bullish. Confluence of signals makes your trade much more reliable. Risk management is where technical analysis really helps. You can use support and resistance levels to place stop losses. If you buy a stock at support, your stop loss goes just below that support level. If it breaks, you know your analysis was wrong and you get out with a small loss. One thing is to remember is that technical analysis is not about being right all the time. It's about probabilities. A good setup might work 60% or 70% of the time. Your job is to take high probability setups and manage your risk properly. Different markets behave differently. Bank Nifty is much more volatile than Nifty. Some stocks respect support and resistance levels beautifully. Some stocks are choppy and don't give clear signals. You need to spend time observing what you are trading. The beauty of technical analysis is that it's universal. The same principle works whether you are trading Nifty futures, Bank Nifty options, delivery stocks, or even commodities. Price action is price action, and human psychology remains the same. One common mistake beginners make is using too many indicators. Stick to a few indicators that complement each other, maybe a moving average for trend, RSI for momentum, and volume for confirmation. That's enough. Another mistake is ignoring the broader market context. You might see a perfect bullish pattern on an individual stock, but if Nifty is crashing, your stock will probably go down too. Always check what the index is doing. Technical analysis also teaches you to be patient. Sometimes the best trade is no trade. If the charts aren't giving clear signals, it's okay to sit on your hands and wait. Not every day is a trading day. As you spend more time doing technical analysis, you will develop an intuition. You will start to feel when a breakout is real or fake. This intuition comes from screen time, from watching thousands of candles form on Nifty and Bank Nifty charts. So, to wrap this up, technical analysis is your toolkit for navigating the stock market. Whether you are a day trader, a swing trader, or a long-term investor, technical analysis gives you an edge. It helps you make informed decisions based on what the market is actually doing. The journey is mastering technical analysis takes time. Start with basics, understand trends, support, resistance, then add indicators one by one. Practice on historical charts. Take small trades to test your skills. Stay disciplined and patient. That's technical analysis in a nutshell. It's a powerful way to read the market's language, and once you learn to speak that language, trading becomes a lot less scary and a lot more systematic. Thanks for watching and happy trading.